Welcome to the Fiscal Physical Podcast. Join us each week as we sit down with the founder of Alchemy Wealth Management and author of Your Fiscal Physical, Ryan Nelson. Tune in to gain valuable insights and practical tips as we simplify complex financial concepts into digestible lessons. From budgeting to retirement planning, this podcast is your go-to resource for mastering financial literacy.
Welcome, everybody, to this week's episode of the Fiscal Physical Podcast. My name is Aaron Hoisington. I am the host of this podcast, and I just want to thank all our listeners who've been tuning in over the past several months that we've been doing this. How long are we doing this for? 6 months? Holy cow.
This would be, I think 7 months.
7 months now? Wow, time really flies here. And that voice you just heard was the founder of Alchemy Wealth Management, Ryan Nelson, also a published author of Your Fiscal Physical, 7 Keys to Becoming Financially Fit. Check that out on Amazon if you want a good read. Once again, I want to thank all the listeners. We're excited to dive into this week's episode here. One thought I just had here, Ryan. Have you ever read the book The Alchemist?
I have.
Okay.
Have you?
Yes, I have. Yeah,
Nice.
I actually just reread it recently.
Nice.
And I don't, with you being the founder of Alchemy Wealth Management, I didn't know if that book at all played into you naming your company Alchemy Wealth Management, or just odd coincidence.
Yeah, no, not really. There's really no connection between the book and my company, but it's a fun read.
Yeah, it is. It's been sold in thousands of different, or not thousands, many different languages and stuff too. And I found out that the author is Brazilian, and it was, my wife was like, "Oh, I know that author," and I was like, "What?"
That's awesome.
It was just funny. I was just thinking of that the other day. And anyway, fun fact: if you guys want to check out the book, The Alchemist, it's my second favorite book behind Your Fiscal Physical. So
excellent.
Definitely check it out here. But let's dive into this week's topic here, Ryan. We are going to talk about what is a yield curve. And honestly, I Googled this myself before, and I think we've mentioned it at some point on one of the podcasts before, but it is a topic that I'm really still not familiar with. I read this really dry, boring website about it, and I was like, okay, I could see how. So I'm really excited to see how, because you do a very good job of explaining it and breaking it down for, maybe the simpletons like myself here. So I'm going to go ahead and turn it over to you and break down what is a yield curve, and everything that goes along with it.
Sure. So a yield curve, it's a graphical representation of interest rates basically over time. So comparing various short-term and long-term maturity dates. So what's important there is, as it's comparing it, it's using equal credit quality. So again, I feel like there's a lot of buzzwords there. So again, to kind of try to simplify it, it's a graph. So it's showing on a graph along the bottom or the x-axis. That's time. So what we would call maturity date. So you could look at a bond that matures in 6 months, in a year, in 5 years, in 3 years, whatever, 10 years, 20 years, whatever. And then along the y-axis, or going up and down, that would be your interest rate. And so that would tell you, okay, at 6 months, what would my interest rate be? If I go out on the chart to 1 year, what would my interest rate be? If I go out to 5 years, what would my interest rate be? If I go out to 20 years, what would my interest rate be? And so the yield curve itself, it is just those interest rates over different long-term maturity rate dates, just graphed on a chart. So it's just a graphical representation of maturity dates. And again, the big caveat here is it's comparing apples to apples. So these are all equal credit quality. So when you're looking at a yield curve, you would want every sort of point on that graph to be equal credit quality. So again, it's just trying to compare apples to apples.
Interesting. And is it just with bonds, or can it be used for other things too? Is it credit as well, or loans? I don't know because I feel like I've seen it on my mortgage statement. They have maybe a yield curve or something that you can look up, and it has same thing. It's time and interest and payment and stuff too. But I don't know if it also applies to that. I'm not
sure what you'd be seeing on your mortgage statement. It's possible they would have a yield curve on there. It's doubtful though. Typically, when people talk about yield curves, they're oftentimes talking about treasuries. And so that would be basically debt issued by the US federal government.
Okay.
And so the most common, typically when we're talking about a yield curve, we're really talking about treasuries. That being said, you could in theory create a yield curve on anything. So anything where you have varying yields, so varying interest rates that differ depending on time you could create a yield curve for it. For all practical purposes, really, when you hear something on the news about a yield curve, they're going to be talking about the US Treasury's yield curve. But again, in theory, you could create this tool for anything, for sure.
Yeah. Okay. Gotcha. And as far as like the different shapes of a yield curve, because when I looked it up, like there's different ways it can go, and like we talked about, I was trying to remember, and I didn't go back and listen to the previous episode, but what's the graph with the hockey stick? Like,
well, we were talking about just compound
interest.
Yep.
with the yield curve. When I looked, I was like, oh, that kind of looks like the hockey stick, but it's not.
Yeah.
Like,
it could definitely have a similar type shape. So yeah, the compounding interest is going to go up and to the right. Yield curves can do a little bit of everything. So a normal yield curve would be up and to the right, meaning if you got a 30-year bond, it would pay more than a 20-year bond. A 20-year bond would pay more than a 10-year bond. A 10-year would pay more than a 5 more than a 1, so on and so forth. So the further out you go, the higher interest rate you're getting, right?
Okay.
So the further you go to the right on this chart, the higher up your interest rate is getting. And so that would be what we'd call a normal yield curve. An inverted yield curve would sort of be the opposite of that. So there can be economic situations where the further you go out, the yields are actually smaller. So a 30-year bond might actually pay less than a 10-year bond, and a 10-year bond may pay less than a 2-year bond. And so that'd be what we call inverted. So if you were to look at this chart, it would actually kind of head down into the right. And then there's just a flat yield curve. You can just think of that as just a flat horizontal line. That'd be where basically if you bought a 30-year, a 10-year, a 5-year, a 2-year, a 1-year bond, they're all paying you the same. So there's no real difference in maturity date based on what yield you're going to get. So those would be the three shapes. Normal is up and to the right. So it's going up the further you go to the right. Inverted, it's going to be going down to the right. So down the further you go to the right. And flat would just be flat. Okay. So those would be the three main types of yield curves we're going to experience.
Gotcha. And just a little teaser. Hopefully you guys will join us next week. We're going to dive a little bit more into one of those things that Ryan just talked about as well, too, when it comes to yield curves. But my question, Ryan, is with one thing I've learned with investing, and I say investing with air quotes because technically you're doing my investing for me. I'm just giving you the money. I tend not to look at my portfolio. I really don't care that much. I feel like I'm in a good spot, specifically with who I trust handling my money, who's doing this at a full-time job, everything. Is the looking at a yield curve, one, where can you find this? And then two, is it important to connect with in your mind, or is there certain times when it's more important? I'd be curious to hear your thoughts.
Yeah. So the best place to go find the yield curve is you can just go directly to the US Department of Treasury, and they post this every single day, I believe. And so if you go to if you just Google US Department of Treasury yield curve, you're going to find it no problem. Mm-hmm. And they don't actually show it as a graphical representation. They just show a chart that says, 1 year is going to pay this, 5 years paying this, 10 years paying this. But it's obviously the same exact data. And again, that's posted, I believe, daily on the U.S. Department of Treasury. So I always like to go kind of straight to the horse's mouth. There's another website out there. Well, you can find probably lots of different websites that sort of graphically represent it, and it might be a little more visually appealing. Mm-hmm. But again, I think there's something to be said about actually going to the source of the actual
absolutely.
data. So that's where you could find the information. I would say to answer the other part of your question, what a yield curve would be used. First, I'd say let's think about what the yield curve is actually doing. Mm-hmm. And so if we think about that, kind of what we call a normal yield curve, again, it's up and to the right. So what that means is if you buy a 5-year bond, it's going to pay you a little bit more than a 2-year bond, which sort of intuitively makes sense. So if you were going out to buy a bond and you want to lock away, let's say $10,000 of your money. Well, if you're going to lock it away for 5 years or 10 years, you'd expect to get some more money than if you were only giving it up for 1 year, right? Or even 1 month. You're taking more risk sort of locking it away for 5 years versus 1 month. And so you would expect by taking more risk to get a little bit more return, right? Now, so that'd be a normal yield curve. And so again, up and to the right. And so basically what that's sort of indicating is you're getting compensated for the risk you're taking. So if you think about that, you'd say maybe, Ryan, why would the yield curve ever invert? Why would sometimes a 10-year bond pay less than a 2-year bond? That doesn't make sense to me. You're taking more risk, right? And so there could be scenarios where interest rates are maybe really high right now. So imagine you are the US government. And let's pretend, I'm just going to throw random numbers out there that aren't even are not relevant.
Hopefully they're round.
Yeah. So let's pretend interest rates were a theoretical 10% right now. So if you went and bought a 1-year bond, you'd get paid 10%. Well, 10% is pretty high. Yeah. And so the government may say, gosh, if we were going to issue a 10-year bond, do we want to issue it at 10%? That's going to be pretty expensive. And they may start saying, well, we think like 5 years from now, interest rates are going to be quite a bit lower, maybe back down to 3% or something. Mm-hmm. And so they would say, gosh, if we issued a 10-year bond and paid 10% on that, we'd really be overpaying on the whole second half of that loan, right? Or that debt, that bond. And so they may say, okay, we think interest rates are going to go down in the future. And so, to a fair rate, if somebody's buying a 10-year bond, a fair rate would no longer be 10%. Yes, they're 10% now, but it's not going to be 10% over the whole 10 years. So maybe they pay something like 5%. And they say, we're anticipating and sort of pricing in, if you will, interest rates to go down in the future. So we're going to pay you 5%. And then you could look at that and say, oh, okay, so I could get paid, maybe 10% for 1 year or 5% for 10 years. And you may look at that and say, well, that sounds pretty attractive to get 10% for 1 year. But if I buy 10% for 1 year, once that 1 year is up, I got to go buy another one. If they're down to 3% at that point, I'm going to have to buy 3% for the next 9 years. And you might say, well, gosh, it kind of, 10% for 1 year sounds really good, but I look at this over all 10 years. Gosh, I might be better off just locking in that 5% and getting it for all 10 years if I think interest rates are going to go down, right? And so that'd be a theoretical or example of why yield curves could invert and why in the future the yield, so a 10-year bond could pay theoretically less than a 2-year bond. And that's really all the yield curve is. It's not that, like in a nutshell, that's all it is what interest rates you're getting at what duration or maturity of bond.
Great. Awesome, Ryan. Well, I think that really breaks that down there. And like I said, U.S. Department of Treasury, you can just Google yield curve to just if you guys want to check it out and such.
Yeah, absolutely.
So appreciate you breaking that down for us here. We'll go ahead and take a pause here, and we'll be right back on the other side.
Awesome.
And now, to put the personal in personal finance.
Welcome back to this side of the Fiscal Physical podcast. I am here, as always, with Ryan Nelson, and we're going to get into something that is always fun, holidays. We all love holidays, I would assume. Everybody does here. And so I'm curious, Ryan, what is your favorite holiday to celebrate?
I love all the holidays. They're all super fun, right? I think in general, people just have like a kind of a more positive attitude and stuff around the holidays. So I think they're all super fun. My favorite is probably Christmas though. I think, like somehow it's taken over like an entire month.
Yeah.
So,
yeah.
Hard to beat a month of holiday versus a single day. But honestly, they're all fun. The barbecue holidays kind of in the summer are a blast. Thanksgiving's awesome. Christmas is awesome. New Year's always kind of like a fresh start. This is kind of an exciting time of year. I think they're all a ton of fun. What about you?
Yeah, you mentioned great points there for sure, because I feel like my favorite holiday is whatever one I'm celebrating right then. Like that's just kind of how I am with it. But, love 4th of July. Love that. It's a, really, I don't want to say a kickoff of summer because it's already kind of started, but you're really knee deep in it right now. And you're like, wow, the weather's normally pretty good. But I also love Thanksgiving because at least in the past, I've always gotten Thanksgiving and Black Friday off. So I get a 4-day weekend. Yeah. And so that's always really nice. I celebrate it with my family. And so I probably have to say Thanksgiving, but
nice.
Like I said, take your pick. Like as far as I do feel like my spirits come up. It could be Flag Day, and I'm like, oh, I love flags, that kind of thing. And so it's just you just whatever you're in the moment of, and morale's higher during those times for sure. So awesome. Well, that will do it for this week's episode here. Once again, want to harken back to thanking the listeners. Check us out wherever you get your podcasts at: Spotify, Apple Podcasts. Pretty much anywhere where you're listening, we're going to be posted. And I'll go ahead and turn this over to Ryan to play us out here.
Thanks. As always, stay the course.
Thank you for joining us for the Fiscal Physical Podcast. Until next time, happy listening, and as always, stay the course. If you have a question or topic suggestions, please email us at podcast@alchemywealth.com. If you enjoyed today's discussion, subscribe to the podcast to ensure you never miss an episode, and consider leaving us a rating and review on your favorite platform. This helps other listeners like you find the show. For more resources, you can visit Alchemy Wealth Management's website at www.alchemywealth.com or find your Fiscal Physical, the book, on Amazon. We'd be remiss if we didn't mention that personal finance is just that, personal. Please don't take anything we say as advice. The preceding content is for informational and entertainment purposes only. It's not an offer or a solicitation, nor should it be construed or relied upon for tax, legal, or investment advice. It doesn't consider your personal financial situation or objectives and may not be suitable for you.